The first numbers you see are going to scare you, but we'll break it down for you on today's Unnamed Real Estate Podcast. Hi, it's Wednesday the 23rd. This is the Unnamed Real Estate Podcast. My name is Charles Ray Dawson, Associate Broker and Residential Sales Manager for ProStar, and this is episode 56. And today we are going to discuss what I wanted to discuss last week about a document that will freak you out when you see it for the first time. This is a very common thing with most buyers. The buyer has gone out and find themselves a lender. They've talked to the lender. The lender's explained things about closing costs and points and taxes and prepays and impounds and escrow fees and this and that and the other thing. And up until then, it's just this nebulous words. Occasionally they'll flash a number at you. Numbers, words. But you get the pre-qual letter. All right, that's saying that there's a lender out there who will loan you the money good for what you want to write on a property. You go out there, you find the property, you send out a lot of contracts, you get the contracts actually accepted, and as soon as you get a contract accepted, your real estate agent sends a copy of that off to escrow with your earnest money to get escrow opened, and they send a copy off to the lender. And the lender starts the actual application. Because up until then, most lenders, you haven't actually formally started the application at that point. All right, it's once there's a contract in hand, they have some numbers to work with and they can start the process. And it's going to be about a day or two, sometimes it's the next day, and you're going to get what's called a loan estimate, or the LE. These things used to be called the good faith estimate. And the good faith estimate was pretty much pre-2008, 2010, right about in there. The new loan estimate is there to make your loan costs more clear to you. Now, this thing was all started by Congress as part of that big let's fix real estate package they came out with back in the day. And like a lot of these legislations that come out with, a whole bunch of people get together in committee with a whole bunch of ideas. Some of them may or may not actually be involved in real estate. Some of them were just assigned to that committee by their party chairperson. Some of these people are just lobbyists, and they're going to make sure that whatever gets written is going to be best for their individual clientele and not for everybody else. I mean, it's Washington, all right? If they fixed every problem that they could actually fix, they wouldn't have anything to do with the rest of their lives, all right? So, editorial. So they came up with this loan estimate sheet, and they put a lot of stress on lenders, and a lot of the hard lifting got sent over to the lender's side, because during the crash, there were a lot of people running around crying up and down saying, I didn't want to take that loan. I had two lenders mug me in the parking lot, and they put a gun to my head and made me buy a house for much more than I could afford. They didn't check my income. They didn't even verify that I actually had the job I told them that I was working at. And they should have known better, right? They just gave me money, and they didn't know that I wasn't actually working there. So these new laws and regulations and everything that came down were supposedly trying to fix this problem. And what they did is they did clarify a lot of stuff. They did clean some stuff up. But they also made things even more confusing later on. And they actually got to the point where they were making lenders responsible for disclosing charges that they had no control over or any knowledge of. All right, because it sounds like a pretty good idea, right? We're gonna make you, Mr. Lender, deliver a document within a certain amount of time period after contract is open, and you're going to be telling the borrower/buyer, what all their costs are going to be. Now, in many cases, the lenders don't have the ability to get that information, but they still have to have put something down on the document. So they do what everybody does in this situation. They drastically overinflate your actual closing costs at the end of the day. They do try to make this as accurate as possible, but some of these things they literally can't tell you whether or not the fee is going to be required, what the third-party vendor is going to charge for that service, so they tend to overestimate. Reason why I'm telling you this story, and the reason why we're having this episode this week, is because one of my protege's buyers had the complete freak out when he was thinking that he only need to come in with basically $25,000. And then he got a loan estimate saying he needed to come in with $31,000, all right? And that $6,000 difference for a lot of people out there, especially working class people, that's a lot of money. And so I helped my protege out by teaching him how to call escrow, get costs, run the taxes yourself, and try to sort of formalize those numbers and everything to give the buyer the peace of mind knowing that even though worst case scenario where every charge got hit, all right, was going to be that amount, it was more likely going to be the original number that we discussed. Now, I always tell all of my buyers when they ask me about closing costs, and even if they don't ask me about closing costs, they might not know to, right, that for any property above, say, $250,000, all right, so $250,000, you can pretty well estimate 1.5% of whatever the purchase price is going to wind up being your closing costs. It's a lot of these costs are fixed. So of course, when your purchase price is smaller, it's still going to be a fixed cost, so it's going to be a larger percentage. Right. But 1.5 is a really, really good rule to work with, and that's what I always tell people. So whatever your down payment's going to be for the loan, add another 1.5% on top of it. So for an FHA buyer out there where you need to come in with 3.5% down payment, right, I would figure another 1.5, round that up to 5%. So if you're going to buy a $200,000 house, you need, 5% of that, $10,000. Make sense? Yes, I know it does. I'm trying to visualize the fact that could you even find a house for $200,000 anymore? And if you did, could you actually get it with an FHA loan? Probably not, but that's a hypothetical situation. So to help me explain these things to you, I asked one of my lenders, Pat Diamede. You've seen him on one of the earlier episodes. He was one of my first interviews I did, to send me if he had a training copy or a scrubbed copy of an actual loan document, so I can show it to you here on the screen, and we'll go through it line by line. I know, line by line. You guys hate hearing that by now, but all right. The loan estimate comes across, all right, and you're going to see black and white with a bunch of numbers on it. But this is a document that's going to be clarifying what your loan is and how much you're going to be paying at the end of the day. All right. So you sit here, you kick off with it. This is going to be your loan company, even though you only think of, I'm just working with Pat. That's the company that he's working for. Right. It's going to have the date issued. That date should be the day that they send it to you or the day before. Right. Applicants, that'll be your names. Hey, double check these things. Some of these people have a lot of different clients and whatnot. Make sure you get the right estimate. All right. Same thing. Make sure they get the right property address. Now notice this property right here is going to be in Sun City. All right. Sun City West to be exact. That's going to have an impact later on, and I'm going to show you that. Right. And on the right hand side of the top where we're looking at here, this is where we start getting into the details. Right. You're getting a 30-year loan for purchase. You got a fixed rate loan. This is going to be conventional. Your loan ID number is going to be right there. All right. The first four of those things is actually going to be the company and the loan officer. The rest of them are going to be the numbers unique to you. All right. They're also going to tell you whether or not the rate has been locked. All right. Locking the rate basically states that because the rates fluctuate every day. All right. Right now, if anybody asked me, should I get a rate lock? I'd be saying, why didn't you already? All right. Get the rate locked in as soon as possible. When rates are going up, you want the rate locked in on today's rate, because 30 days from now when you close, it probably will be higher than this month. All right. And if you're in a market that's declining, all right, like we have been up until about 6 months ago, 9 months ago, right around there when rates started to go up, you could actually hold off on locking in the rate. All right, you could play around with that, and maybe in the course of that time, you'd see the rate come down a little bit. But right now, you want to lock that rate in. So check that box. Make sure it says it is locked in or not locked in, as the case may be, but whatever it is you wanted. All right. Then we're going to discuss what the loan terms are. Loan terms are how much and what's your interest rate. Right, in this one in particular, they're borrowing $352,000. They have an interest rate of 3.875. Right, might want to lock that sucker in right now, with a monthly principal and interest payment of $1,655.23. They will also tell you straight off, can this amount increase after closing? No, it can't. Interest rates cannot go unless you're doing an adjustable rate mortgage. And if you are, stop. Don't do that. All right. Asterisk, Ray's not a financial advisor. All right. But stop. Don't do that. If you project out that the rates are going to go up. Right. Just historical fact. In 2007, part of the reason why the training wheels started coming off the entire thing was we had a whole bunch of people in variable rate loans, and they were betting that they would be able to refinance before they had their rate jump that would suddenly make their mortgage payments unpayable. They were betting that they'd be able to refinance the loan and lock in a lower rate. Because those adjustables, what they do is they come in with a much, much lower rate, right, for like 2-3 years, and then they adjust to another rate after that. And that's something you can do. I mean, let's say, what would be a good example of that? Let's say that you know you're going to get in the big promotion, you're going to be able to afford a higher rate. Or let's say you have something right now going on that is going to be taking a little bit more money out. Let's say you're paying off student loans and you're going to get those things paid off in 2 years. Somewhere out there, I just heard a noise, and I couldn't tell if it was a person with student loans sobbing or laughing out loud, but it was definitely some sort of guttural cry. So, but in that case, people might do adjustable rate. All right, it's individual to you. Talk it over with your financial people. Talk it over with your loan officer. They'll give you the pros and cons on this. Don't listen to real estate agents on these things, right? But in this particular loan, it's saying right there, this can increase. Underneath, we're going to have something called a prepayment penalty. Now, prepayment penalties are a penalty that you would be charged if you paid the loan off early. That includes a refi. All right. That includes selling your house and paying the loan off. A prepayment means you did not pay out for the whole 30-year amount. You paid early, and they could charge you a prepayment. You don't see these through commercial loans anymore. I have seen them, but they're usually done by people who are carrying the loan, individual people, and they might have like a 10% prepay penalty on top. So keep an eye out for that. And the last one on this is whether or not it's a balloon payment. A balloon payment is where you are not paying off on a 30-year fixed with a balloon payment on the end. The monthly payment that you'd be making, the $1,655.23 seen right here, all right, would not be enough to pay off all the principal and interest by the end of it. So at the end of the 30 years, there'd be a final bill come due. All right, so that would be no. But majority of loans out there are not going to have a prepayment. They're not going to have a balloon. All right. But legislation says that they have to make it on here to distinctly call out this is not having a prepayment, and this is not going to have a balloon. Now, little aside of this thing, all right, if you were in forbearance on your loan because of COVID, and because your COVID forbearance and whatnot, you wound up having a little chunk of payments you did not make. Let's say 6 months. You didn't make payments for 6 months until you got your job back or whatever it was. A lot of these banks, instead of making you pay the 6 months all up, are either adding it to your payment to catch you up on it, or they're going to be putting it at the end of the loan when the loan comes due. Then all of a sudden you have a balloon payment, right? They'll probably have a document in there where you have to sign saying, I understand that my original loan estimate, my original loan is now being modified, and there will be, because I did not pay for these 6 months, there's going to be a balloon payment of those 6 months, including interest, at the end of this loan. All right. So if you were in forbearance and you got something worked out with your loan company, and you have no idea what I'm talking about right there, you need to call your loan company up and see how they actually resolve that issue. All right, so little tip there. Now, coming down after this, we're going to see the next category, and this is going to be your projected payments, right? This is going to be what we call PITI, property, interest, taxes, and insurance. This first number right here is just principal and interest, right? This next one coming in repeats the principal and interest. Now, this particular one, they don't have mortgage insurance. Right? Mortgage insurance kicks in if you have less than 20% equity in there. With a loan amount of $352 and a sales price of $440 up here, they're putting 20% down. So they don't have to have it mortgage insurance. If there was, it'd be showing right here on this line. And then also on this, you'd have estimated escrow. Right. Most lenders are going to take taxes and insurance up front with your mortgage payment. All right. And then they will pay the insurance company and they will pay the taxes. This protects the lender to make sure that your property that they have lent money on is properly insured and that the taxes are actually getting paid so they don't suddenly lose a potential asset because the state stole it. So this particular case, and if it's paid in that, it's going to say right here in escrow. This loan right here is not there. So property taxes are not being held in escrow. Homeowners insurance is not being held in escrow. Right? But if they were, it would have added an additional $186 monthly to the projected payments. Does that make sense? Excellent. This is a number everybody jumps to. They see this thing, they go right down to the bottom, and they look at the estimated cash to close. $100,369. That's the check that the buyer needs to bring to the table when they close that escrow. And of that, $12,369 is estimated closing costs. So when I was saying about people suddenly like freaking out and everything like that, you know, they could be sitting there and thinking to themselves, wait, I only needed to come in with my down payment, and now you're making me come in with another, you know, $20,000 or $12,000 or whatever. What the hell's going on? Case in point, my protege's problem earlier this week. So what happens here is your estimated closing cost gets called out. And remember, this is an estimated number. Everything has to get rounded up. Right? They can come down on these numbers. They can't go up on these numbers. Right? So it's going to break it down that this includes $6,363 in loan costs plus $606 in other costs, zero in lender credits. Stopped recording there because I was about to sneeze. I haven't sneezed yet, so it might come out on me, but I was really hoping I could time it with a quick break. But so back to estimated closing costs. This is coming in at $6,300 in loan costs and $6,000 in other costs. All right. Adds all together to their cash to close. The next page, page 2 here, breaks down the details of where those costs are coming from and what they are. Each one has a little different section. Each section is a different type of costs and everything. Like I said, these numbers are estimated a lot of times, and so we can see that. The loan costs and loan origination charges they're not necessarily set in stone, but the numbers are accurate because these are actually the lender's costs themselves. Now, lenders do have credits, and lenders can apply these credits to your loan and bring this number down. But in this case, your origination charges are $2,789. Right? And you see how that's broken down. They're paying some points. There's a processing fee. There's an underwriting fee. So that's the cost of the money. Then there's other charges, appraisal admin fee of $100 and an appraisal fee of $425. Now, you can't shop for appraisals anymore. That was also one of the results of the legislation that made this document is, well, long story short, the appraisers didn't have a lobbyist in the room like the banks did and like the National Association of Realtors did. And so the appraisers really got hung out to dry. They're the only people out there who have a statute against them that says if they get caught doing bad, they can actually go to jail. Think about that for a second. It's the reason why we buy our lobbyists to buy our congressmen. So, but what they do call out is they sit there and say, hey, appraisal fee of $425. That is potentially a low number. The loan officer is actually going to call their company. We have a third-party company out there that basically plays spin the Rolodex. You call this company up and say, hey, I need an appraiser. They spin the Rolodex, and whoever comes up, they say, okay, your appraiser is this person right here. And we're going to charge you $100 for spinning our Rolodex. All right, the appraiser is going to charge you $425. You can't impact, and the lender can't impact those charges because we can't pick who we work with anymore. All right. You might get a bad appraiser. All right, because we don't have any feedback, or bad appraisers don't get phone calls and bad appraisers don't get work, so they go out of business and go do something else. You now have these appraisers who just sit there and the phone's going to ring and they're going to do a job and they're going to turn their job in and they're going to get a check. And the phone's going to ring and they're going to do a job and they're going to turn their job. And if anybody argues about their appraisal, they just go, I'm the appraiser, deal with it. So that's a fee that you're going to be forced to pay. All right. Flood certification on this particular piece of property, because of its location, they needed to have a flood cert on it. All right. And then in this one, there is a rush fee of $125. That would be in case, get this, you suddenly need the appraisal faster than the appraiser was actually going to deliver it. Then you bribe them with $125 to get them to go out there and do it quick. Another issue you can have on these things is a re-inspection fee, which I think is just a great racket. I'm an appraiser doing an FHA loan or a VA loan or something along those lines. I find something wrong with the property so it does not qualify for a VA or an FHA loan. And then you bring me back 2 weeks later and I verify that it's actually been fixed, and I'm going to charge you another $125 for it. Right? Yes, every once in a while I actually sit there and I think that these appraisers are finding stuff specifically so they can get the fee to come back the second time. All right? My opinion. All right? My bitter opinion. So that covers the services you cannot shop for. Now, the services you can shop for, and honestly, you've probably already done it, you just didn't know it at this point in the process, is your title and escrow fees. All right. So title and escrow, what we've covered on this before. Title is sitting there and making sure that the person selling you the property owns the property and it doesn't have any encumbrances on it like taxes or other liens or anything. They're selling you a free and clear property. Escrow is paying off anybody who needs to get paid off, right? They're taking the money, they're taking the keys, they're making the transfer, and they're releasing them both at the same time. They're the neutral third party. And they charge for this again. First one is a closing protection letter. All right. That's a fee off the top. I don't know why they just don't roll that into the escrow fee, but you're right, it's different. The escrow fee is how much the escrow officer and title company is charging you. There's a title endorsement fee down here at the bottom. That is usually because the lender has required a special endorsement of some sort on there. The title is going to make sure that they verify. And then you got the lender's title insurance. All right, this is the big ticket number. The big lender's title insurance is that you're buying an insurance policy to protect the lender just in case title screwed up and did not realize that the person selling the house to you did not actually own it. Great racket. But it's a requirement for the loan, and it's the way it is here in Arizona is that you, the buyer, are buying a policy for your lender, and the seller is buying one of these policies for you, the buyer. The reason why they say you can shop for this is that you could change to another title company if another title company had lower rates. These rates are pretty much, they have to be registered with the states for the insurance. All right. They're public. They're easy to find. Most title companies have a link off to their website where you can go there and go, give me the cost, the escrow cost for this property right here at this purchase price. And this is our down payment. This is going to be the loan amount. And they will give you these numbers right there. If the lender hasn't had a chance to check that, or we're not sure who escrow is going to be, they will estimate all of those costs and they'll be pretty high. All right, so, but that's the number that adjusts off of that. These three categories becomes total loan costs down here, A, B, and C. That comes to $6,363. The next column are the other costs that come in. And these are going to be a lot of the governmental fees, a lot of the insurance fees and everything, but they're not considered loan costs, or considered the other costs, right? So the first one is recording fees and other taxes of $100. That's to record whatever documents they're going to want recorded. Most cases like this is going to be the deed of trust, okay? And sometimes they'll make you do a reconveyance on this, and they'll charge you for that up front. There'll be prepaids. Now, a prepaid is you are paying money in advance to get the homeowner insurance policy going. If there's a mortgage insurance premium, they'd be charging you right up here. All right, and any prepaid interest for taxes. And one of these days I should do an entire class just on how the taxes get prorated and this and that and the other thing. But it's math, and usually we let escrow handle those things. But in certain cases, they're going to be making you pay taxes up front. So remember when I said up here, right, that some companies will collect all these things in advance? They're going to ask for prepaids up front, so they have that money in their escrow account to pay for it when the bill comes due. Right. In this particular case, they're only pulling 1 day's worth of prepaid interest, probably because this thing was going to close really close on the line or something like that. So they're only going to pull out another $37 for that 1 day's worth of taxes, right? And the insurance premium of $900 for a 12-month, 1-year policy. That number right there is really high, all right? Not knowing anything about this property, but just looking at the sales price, you could probably get that $900 knocked down to about $650, $700 if you call your insurance company up. Call the same people that you got your car through. See if you can get all that bundled. Right. Another initial escrow payments they might ask for, all right, is home insurance, mortgage insurance, property taxes. That's different than the prepaid. The prepaids are actually getting a check cut and sent to the company or the tax company, county, or whatever. This is anything that's going to be held back in escrow. So you'll see that number change. And then Section H right here. This is when we talk particular to this is Sun City West. Now, I mentioned earlier that 1.5% is pretty much the average of what your closing costs should be on this. Right before I started the video on this thing, I ran the numbers, and if anybody's been looking at this and calculating the math in their head for those engineers out there who can do this, you're going to realize that $12,000 is 3% of 440. All right, and rounding, all right, not 1.5%. Okay, and I know a particular engineer who's really, really good at pointing stuff like at that, and I can hear his voice going, "That's not 1.5," and I'm like, "Yeah, it's 3," because we have a very special extra charge on this whole thing, and it's called Sun City. All right, they're going to charge you, the buyer, a $3,700 capital improvement fee to move into their community. There's a new member fee of $994 to move into their community. And they have a transfer fee of $275 to move into their community. So just to walk in the door over there, you got to pay $5,000 up front. Right? Add all these costs together, and there's your additional $6,000, and that brings you to $12,000. Finally, at the very end of this thing, you have the calculating cash to close. Tell you the total closing costs. That's what your down payment was. If you already have a deposit in there, they're going to be putting that in there. If there's any funds coming in for the borrower, it's going to be there. If the seller is crediting you for your closing costs, it's going to be there, or any other adjustments or credits. These we'll see, or in some cases, you can actually finance your own loan amount. Wrap some of these costs into your loan and pay it off over time. That would be there too. But that comes to be a complete estimated cash to close of $100,369. Last page on this comes in with additional information. This is where they're going to clearly delineate. This is the lender you're working with. This is the loan officer. This is everybody's licenses and contacts information. Right? And they do comparisons over here. All right? You can use this to compare with other loans if for some reason you're working two lenders against themselves. Right? It's going to say the total you have paid in principal, interest, mortgage insurance, and loan costs, and after 5 years, it's going to be $105,000. All right, and you're going to be paid off of that a grand total of $34,272 will be the principal that you have paid off by making monthly payments of the $1,655. So your annual percentage rate, and this they need to change this term, annual percentage rate. Congress makes them call it this. I don't know why. All right, but it's your costs over the loan term expressed as a rate. It's not your interest rate, but they make you calculate it like it is an interest rate because they figure people understand interest rates better than they understand total costs over life of loan. All right, so they make it say it like that. So a lot of people will see that number and go, wait, 3.9. I'm not getting the 3.9. I was promised a 3.8. What the hell? All right. But that's the reason why we call it that. You'll see that on pretty much anything that if there's a car loan, car payment or something with a loan, they're going to have the APR in there. Credit cards are going to say APRs over that. It's just your extra closing costs or your other charges during the course of the year added to the balance and made as a rate. So the other thing there's going to is the total interest percentage. All right, when this thing is all said and done, right, it's going to say out there that of all the money you pay them, 69% of it's going to be going to interest. All right. So a lot of people don't understand that about, especially 30-year loans. you're going to be paying a lot more in interest. You're going to be paying a lot more to buy the money than you're paying to pay for the house in cases. So there's a trick to that. Make a bigger house payment. All right. If your house payment, I mean, let's take these guys, right, for example. All right. They're paying $1,655 a month, plus $186 monthly for taxes and insurance. Let's say that rounds it up. If they round this whole thing up and cut a check for $2,000 every month, instead of the 18 whatever it's going to be, they will be paying off about $150 a month times 12. All right. It starts eating into the principal, which means there's not a principal there for them to charge interest on. So at this point, we're done. Last couple considerations here to come in. They're going to say we may order appraisal. Read that as we will order an appraisal. They always do, right? And they're always going to make you pay for it, right? Actually, there is a couple places out there saying that they will pay for your appraisal, but those tend to be refinance companies. They'll pay for the appraisal, the refinance, and honestly, what they're going to do, they're going to wrap it into your closing costs. All right. They're also going to tell you whether or not the loan is assumable, by whether or not it can be. All right. It can be. They keep using the term assumption on this, or allow assumption of as a verb. I'm using the term, assumable as an adjective. All right. So they will not allow anybody else to assume this loan, which means you can't just hand the loan off to somebody else and have them pay it for you. All right. They are going to require you to have homeowners insurance. All right. They're going to charge you a late fee of 5%. If your loan is 15 days late, calling that right out there. All right. They're letting you know you might not actually be able to refinance this loan because it's dependent on your future financial situation, the property value, and any market conditions out there. All right. So just understand you might not be able to refinance out this. They want to make sure you know that. And the last one is that they intend to transfer servicing of your loan, which is 99 times out of 100, your loan is going to be sold to somebody else before the ink actually gets dried on it. You will be asked to sign the bottom of this, right? So they have records saying that they actually gave this to you in case they ever get audited, right? If there's any addendum stuff, it would be right here under the addendum, usually blank. And there's another here acknowledgement that you actually got the document. That is the LE. That is the loan estimate. Like I said, this is the number that the first document that shows up that tends to really scare people. Now you know how to break it down. Now you see where all this money is going to, what the payments are going to get made. We know which ones we might be able to change because of the title company. We know that this is overestimated numbers. Right? And always remember, this amount right here is always going to be the worst case scenario. So speaking of worst case scenarios, let's take a look at our numbers. All right. Nothing really major going on. All right. We are still dropping on active listings. We're at 4,453, down 74 from the week before. Our new listings did go up. We had 2,258 new ones come on the market, which is 62 more than last week. Remember, we had a little dip last week for whatever reason. We still had 1,991 properties go pending, meaning they went under contract. We had contracts, with looking for backup, or 1,145. That's up 16. Remember our numbers on this thing. I might have to redo this entire how to read this chart class, but actives can go directly to pending. They could also go here. They could also go down to contracts with the buyer's contingency. Here they're at 72, down 16 from the week before. Hopefully everything winds up in the closed category, where we had 2,067 closed last week, up 72. And coming soon to an MLS near you is 939 new listings. So numbers are still coming down. We should be gaining in inventory right now. We are still dropping, even with the interest rates and everything changing, which of course is going to mean people are going to be less qualified buyers out there that might have some slowing on the market. What really is that's going to mean is that the people who have waited to the spring to start looking are going to have to be looking at smaller houses if they want their location, or they're going to have to start moving locations if they still want the size. Don't see any of this thing cleaning up anytime soon. Saw another article this week, much like the previous article. Oh my God. And, you know, except this is one of those, housing sucks and it's all Biden's fault. All right. And I read the article and I'm like, no, that's just general suckage right there. I can't specifically say, no, this policy right here, this little thing that he did is screwing everything up. Now, that being said, and getting really close to the political stuff, I never want to on this. This morning, I'm recording this on Wednesday. Russia's rolling into the Ukraine and stuff like that. I haven't refreshed Twitter in the last 30 minutes, so who knows what the hell just happened. Right. But they were already having the articles come out that your inflation, your gas prices, and your supply line issues are all because of the Ukraine. All right. I'm pretty sure by this time next week, I'm going to be reading some Twitter hot take about hellacious housing prices, all because of Putin and his conquest of Eastern Europe, right? Because that's just what people do nowadays. It's all clickbait. That being said, I will never bait you. I might click on you if I like your profile picture. All right, but I am done for the week. Thank you very much. Have a great weekend. I'll talk to you all later.